Hello, everyone, and thank you for joining us. I'm the CEO of WorldQuant, Mike DeAddio, and I have the honor to moderate this panel today. We have a panel of truly exceptional leaders in the financial industry who will share their thoughts, insights, and experience in this ever-changing time. So the title of the panel is focusing on uncertainty. And I think maybe the one thing we can say with certainty is that the pace of change is just accelerating rapidly on all fronts. We'll talk about the role of technology, social media, the fact that data is exploding exponentially and it can be used for prediction in ways that we just haven't thought of before. And then obviously there are the political winds of change, anti-globalization, and populism are showing themselves in all different ways around the world. And then there's the word disruption. Disruption seems to be our word of the day. Maybe it's not as overused as data sciences these days, but it's close. But it truly is the concept of our time. And there's no place to hide from it, if there ever was. And you can even look venture investing. Almost everyone will tell you they focus on what? Disruptive technology. So we'll talk about these things with the panel. I also wanted to talk about, and leading on from what Mike said earlier, there are obviously major changes going on in the workplace with regards to diversity, gender equality, from the recent internal memo from Google that was published, criticizing internal workplace diversity policies. There's been a CEO Actions for Diversity and Inclusion initiative. Over 175, I think, and growing CEOs have signed it to try and make a difference. And there's an ever-growing body of research that shows even where there's a desire to change, there are subconscious biases that still exist, and there needs to be ways to root them out and really change for the good. So before I move on, I just wanted to give a quick little, we put on slide one on the screen. So this last part is very, very important to me. I'm the father of a 12-year-old daughter, 9-year-old son. My 12-year-old daughter asked me after this Google article came out, is there any truth to it? Is there a biological reason, or is there something real going on there? So I said, you know, we have a call with one of our ventures portfolio companies. They were going to pitch to us because they were doing a terrible job selling a very good system, something along the lines of geeks aren't good at selling. And I asked her to join. And what you see up there is towards the end of the hour of taking copious notes, she slips me this little piece of paper. And if you can't read it, it says, how did they get you to invest in this? It's a great idea, of course, but the marketing is very unclear. To which I said, my dear, you've just answered your own question. I don't have to answer it for you. And there are other reasons at work here. We'll leave to the side whether or not she should be making my personal investment decisions on ventures or I should. We can debate that later. And I do have a question for the panel that will be a surprise at the end that she did ask me to ask you all. So clearly on this front in the workplace, there's a lot more work to be done. So with that, let me very quickly introduce our panelists, and we can get to the questions. We have a great diversity here representing all different types and aspects of the financial community. I'll start with Tina Fordham. She is the Managing Director and Chief Global Political Analyst for Citibank, and the first one to hold this role. She's also was appointed to the UN's first high-level panel on women's economic empowerment. And a little personal note for her, she's a single mother of 2 young girls, 9 and 12. And while she's born an American, she's been in the UK for 15 years. So Brexit, as she said, is her reality. Liew, to my right, Managing Director and Head of Fixed Income for GIC Singapore. She's been at GIC since 1998, and in these changing times, that is quite a long stint. Congratulations. She chairs their currency and risk management groups. She's also a board member of the Emerging Markets Trade Association. And she has 3 boys, 5 and 11, and they drive you crazy.
Yes.
Then we have Elena Okorochenko. Got it right? Thank you. Head of APAC ratings for S&P Global. And while she is in Singapore now, she started her career in education in Moscow. And one of her, and she's on 5 corporate boards as well here in the APAC region. And one of her personal notes, she's extremely competitive. She likes blind wine tasting and Scrabble with her husband and golf. Scrabble, they're even. Golf, she wins. And then Tracey Woon. Vice Chairman of UBS Asia Pacific Wealth Management. Recently as well switched from Citibank, right? And also is the Distinguished Fellow for the Institute for Banking and Finance. And one interesting note for her is that Tracey recently wrote a letter to herself in 1980, essentially saying, if I could tell you, if you could tell yourself what you know now, what would the advice be to yourself back in 1980? And she has posted it online, and if anyone's interested in reading that, it is very, very interesting to think about things that way. So that's our panel. Let's get started. I'll start with the first question. So talking about disruption, and this is in all sorts of ways, social media, data availability, artificial intelligence. Why don't we start with Elena? How is this changing the way you lead your teams? How is it changing your strategic objectives?
Okay, so that's an interesting one, because I think disruption is coming at us from all different directions. And the most obvious one is technology, but it's by far not the only one. We have regulatory disruption. We have disruption coming from the changing social fabric, the fabric of our society. We have disruption coming at us from the environmental point of view and communications, and I can list many, many aspects and angles. So what does it mean in terms of leadership? It means that, well, at least for me personally, I have to think about opportunities that come up from all this disruption, both in terms of products, but also in terms of internal operations and operational challenges. So how do we make the disruption work for us rather than being disrupted and potentially out of business? So it's constant change, and it's also helping the teams navigate the change, distilling the message for them, creating a vision, clear direction, empowering them, and helping them manage through change and through that disruption. So let me give you a few examples from my own industry and how we are dealing with certain things that are coming up. The first one is the disruption, which I think is both technological but also social fabric. In emerging markets, the technology adoption curve of consumers is very different than it is in developed markets. So take India and China, or pretty much any other emerging market, they're going from mobile first to mobile only. They ignored completely this whole, landline and then into mobile, or desktop to laptop to a tablet to mobile. So it's mobile first and mobile only. So what does it mean for us as a business? Do we have to come up with a product that is going to be serving these customers? How do we actually make sure that we maintain global consistency, but at the same time remain nimble and serve local needs as well? So that's one example. The other one is, we hear a lot these days about ecosystems and platforms and the sharing economy. This is obviously a trend, and it's here to stay. So what does it mean for us at S&P Global? Well, one example is how can we best serve SMEs? Should we, for example, create a platform, an ecosystem for SMEs where they can exchange best practices, where they can find potential suppliers and partners to build greater businesses with, where they can apply for funding to banks, so where banks can get information either on individual SMEs or, for example, on aggregate for the whole SME sector. So should we be building and supporting something like this? And I think the answer is yes. Now our subsidiary in India, Crystal, has already piloted this approach, and if you're interested, I can point you in the right direction. But that's another aspect or another example. Another big trend and disruption trend is the whole attitude to sustainability, green, ESG in general. I was at the conference at the Singapore Institute of Directors conference yesterday, and the theme was sustainability. The big I would say the big slogan they are promoting, and I agree with it, is that sustainability will be more than just CSR, more than just corporate social responsibility. It will be part and parcel of the business. Businesses will need it to survive. So as you are working for profit, you should also look at the impact you're making. So it's profit plus impact. So what can we do as S&P Global in that space? Recently, we came up with a product which is called Green Bond Assessment. So we are now able to assess any bonds that are issued globally in terms of their greenness and rate them on the scale and allow investors to actually construct green certified portfolios. We're also working on an ESG product, but I think we can probably go a step further than that and incorporate ESG assessments even in our day-to-day ratings work or other products that we have. Just one more, and then I wrap up the first question. So, data. There's a huge disruption in the data space where data is becoming readily available, and it's what you do with the data that starts to matter more and more. So here, who can own the data space, who can actually become an aggregator of the data, traditional data, alternative data, all kinds of data, and become the single source of data analytics and insights will be the winner. And again, S&P Global is obviously thinking in this space and wants to be the winner. So these are some of the approaches. To sum up, it's thinking in terms of products, but also operations. I won't touch on operations. Maybe some of my colleagues will. But technology, social fabric, communications, environment is all disrupting us. We can take advantage of that.
Thank you. Tracey, I know you've been doing a lot of work on artificial intelligence in the wealth management industry recently, all focused around data, technology, disruption. Can you tell us a bit about that?
I think, first of all, interesting to share some facts with everyone. As Mike said, I've been actually thinking and doing a lot of research in the disruptive technology space lately, just because it's been such a topical thing. And what we found is that, you know, over the medium to long term, actually between 50 to 75 million jobs are going to be at risk, and in Asia, probably more like 30 to 50. Sounds like big, huge numbers, but actually 50 to 75 is 2% of the workforce. And if you think about it, it isn't that jobs are going to disappear. Jobs are going to change. They're at risk and they're going to transform. If we look back in history, there are lots of jobs that were there 20 years ago that are no longer here. So I don't think we should be so terrified about technology. I think technology will make our lives better in that jobs that are going to disappear are the processes kind of jobs. Sure, artificial intelligence is going to get to a point of super artificial intelligence, probably not in my working lifetime, so at least I don't have to worry about that. But I do think that jobs will transform. The one disruption is really in the finance industry as well. When we think about digitization, certainly for banks, do we want to even think of ourselves as a bank anymore? When you look at branches today, how many of you actually go to a branch and do any kind of banking, right? We've gone online. Interestingly, for wealth management is something that we also have to think about. You know, do we think of ourselves as an advisor? Do we think of ourselves as a bank? And if you think about artificial intelligence as sort of the engine for the rocket, then data is really the fuel. And that's what I think a lot of banks have to be smart about, that we obviously have a lot of data and knowledge. How do we use that in a way that we're going to benefit from the disruption and from technology as the world progresses? Our life should change. I think technology is going to make it better. It's really about, as Elena said, I think technology should be looked at as an opportunity as opposed to a threat. I think it's really the banks and the companies that don't think hard enough about digitization and how to make use of whatever fuel that they have today and take advantage of that.
Thank you. So let's move on a little bit to uncertainty in the world. So we have a lot of uncertainty, especially geopolitically. You would think that would cause more volatility in the markets, and it hasn't, at least by traditional measures. So, Tino, could you tell us a little bit about how you see that and what you think the risks and the opportunities are?
Well, I think I'm definitely going to win the prize for least sunny person on the panel, but then again, that's my job as the Chief Global Political Analyst. Normally, I take about an hour and a quarter to take investors or boards through a sort of a scan of the horizon of key risks. But even actually doing that has changed a lot over the last 20 years. And I was thinking about this flying from London yesterday on the 16th anniversary of 9/11. I was in New York. And the business of looking at political risk really changed overnight. Suddenly you had portfolio managers and hedge funds, first of all, wanting to know where Afghanistan was, and then really wanting to know then how this happened and whether something similar could happen again. The risk environment has changed a lot since then, but investors' mentalities haven't changed as much because, in actual fact, the drivers and themes that my fellow panelists talked about, disruption, deglobalization, and these kinds of things, automation of the labor force, are clearly key drivers into the political risk landscape. We also saw this in Vice President Gore's film and remarks last night, right, where drought as a driver of conflict and destabilization. So I divide looking at political risks into two categories. First is the traditional geopolitical risks, and that is where we might think about North Korea and the potential for conflict, which clearly on the minds of investors these days, although not for very long, because the sixth missile test and the notion that a bomb was tested several orders of magnitude larger than Hiroshima moved even Asian markets for about 15 minutes, which is remarkable. As one of my clients said, does it actually have to be in the air headed toward Los Angeles before we get some volatility? That's the traditional type of risk that certainly investors, I would also say of a certain age, are most concerned about. The other type I describe as Vox Populi Risk, and this is something that I've written about extensively. Vox Populi, of course, meaning voice of the people, and those are the political risks that happen at the ballot box or in the streets through protests. And 2016 was really the year where Vox Populi Risk and in advanced economies came to the fore, and we had the election of Donald Trump and Brexit in the UK. And so over the course of doing political risk analysis for the last 20 years, we have moved from talking about really opportunities in emerging markets. Well, investors wanted to understand the landscape in Brazil, in Russia, and all of these places, to trying to anticipate what leaders in developed markets and what populations in developed markets might do. So that is a huge transformation, in fact. The notion that the Twitter feed of the President of the United States might be a source of political disruption is a huge change. I say that slightly tongue-in-cheek, but leaders all over the world are tuning in to Donald Trump's Twitter feed to see what he might be thinking. And even though Donald Trump will not be president of the United States forever, unless things really change,
Let's hope.
I would argue that both Brexit and the advent of Donald Trump's presidency and his sort of direct communication style, the broadening of post-truth politics, not just from leaders, but also the way the public is less interested, right, and wants to sort of we want to have our own ideas reinforced, is incredibly disruptive. But why don't markets react to these things? Interesting question. Markets tend to react to events, first of all, and not to themes. How are you going to react to deglobalization? What does that mean? And meanwhile, the S&P is powering ahead. So although companies are having to change the way they do business and to think about a return, say, to more regional hubs or this sort of thing, not impacting the share price very much, is it? I think the short answer, though, is liquidity, right? Liquidity from central banks and liquidity from shale gas supplies is masking political risk. It's masking it. It's not ameliorating it. And this is really one of my key messages for investors and for corporate clients, especially people who are too young to remember that the period since 1989 up until the Lehman Brothers collapse and the global financial crisis has been the most peaceful and prosperous in human history, right? It's an exceptional period, but investors often make the mistake of extrapolating the way things are now far into the future. So part of my mission, to wrap up, as Elena said, is to try to retrain the way investors think about risks. I want to bring in more ESG criteria and sensitivity to doing that, and to think less about the sort of one-day disruptions or short-term disruptions, but to have a sharper and more accurate lens for looking at this landscape of political disruption.
Thank you very much, Tina. I give you credit for being diplomatic about calling the president's communication antics a style. So on that same point, Sumi, I know that as a global asset allocator, all of this uncertainty brings risk, but it also brings opportunity. So can you tell us from your perspective in GICs, what kind of opportunities and risks do you see?
Sure. This is a very unusual period in that we have so much uncertainties, in fact, very high uncertainties, but yet market volatility is always very low. It's near record low, and valuations are also very high. And then the other conundrum we're seeing is that if you look at valuations, if you look at where things are trading, it is a very classic late cycle type of valuation because of all this euphoria in prices. But at the same time, if you look at fundamentals, especially look at inflation rate, if you look at growth, even in developed markets, they are not quite at your tail end of the cycle. So it is a very strange period where if you look back in history, I don't think you can find any period that is similar to today, which makes the whole investment job very, very challenging because, as you know, for long-term investors like ourselves, valuation often is a good predictor of future returns, especially for an asset class like fixed income, where your starting yield pretty much will tell you over a long period of time what sort of returns you're going to expect from investing in this asset class. So pretty much it's telling us to prepare for a period of low returns, but it is not sufficient to just sit there and say that this is all we can do. And the question is, what else can you do about generating meaningful bottom line impact? And one of our investment mantra is that we try not to predict, but to prepare, especially in situations like today where geopolitical risks are everywhere. I don't think anyone can really know what's going to happen. So it's actually more important for us to look for different sources of alpha streams and build a portfolio that is not so much predicated upon having just one view of the world being right or happen in that way. And if you look away from sort of the more nearer term geopolitical risk, economic risk, which frankly is very, very hard to predict, and everyone can have their views on where S&P can go to, where FX can trade to, and so on, there are certain, perhaps more certain bake in the cake kind of trends that we can think about. One of which is the rise of ETFs in the industry. So as more and more people are going into beta, going into index solutions, we see that it creates a lot of opportunity in what we call driven by behavioral inefficiency, especially in the fixed income index, where players will need to do certain things to replicate the index by the end of the month or when there's an auction. Some of these create somewhat of a predictable behavior from a large group of investor, and that in itself creates opportunities for us, especially when you do not have to sort of produce an index solution because your KPI is very different from one that is managing an ETF, for example. So things like that are what we think are interesting opportunity. And the fact that we now have, the other point about technology is that now you can really build a system that take advantage of all sorts of data to be able to have a more comprehensive comb of the entire universe to make more holistic decisions. And at the same time, it allows us to repeat the process because you can now systematize it. rather than dependent on humans who have to do it based on their memory, based on their experience, and so on. The other thing I would point out is that in the credit world especially, with banks having to deal with deleveraging and financial regulation, which is still ongoing, it actually creates some opportunity in certain segments of the credit market. So whether it is due to balance sheet constraints, some of these direct loan books, and opportunity in certain segments of the market, we actually feel, if you have the ability and that horizon, then this is a huge advantage or opportunity for investors like ourselves. So I was just sharing with, in another session that in the past, we're quite used to this, what we call desktop investing mindset, which is that you lay back, behind your Bloomberg screen, you wait for a new issue announcement, and you do analysis, you like the bond, you like the new issue, and then you place an order, and then you sort of pressure your bank to say, hey, give us good allocation on this. That sort of mantra of the way of investing in today's world is no longer sufficient, because you have a lot of capital, and capital no longer you don't have an edge in that. And secondly, prices are expensive. It's not like you want to buy everything that's on new issue either, especially in some markets like Europe, where you know that central bank policies have distorted prices because of all this demand on UD assets. So the way to think about, creating opportunities is that you have to take the offensive side, which is that you go to companies whom we like, we understand the balance sheet, we know that they can withstand a recession, and then you go back and say, hey, how about coming up with a financing solution? And the good thing about, us sitting on our side is that we have a very long-term horizon, and we are very flexible in terms of the financing options for companies, whether it's loans or bonds or hybrid or even equities, public or private. So I think in that sense, we have to look for different ways to deal with this highly uncertain world, and there are things that we can do.
Thank you. And actually, since I was last around to you, I'll start first with the second round, and we'll wait till about 10 minutes, and then we'll take questions from the crowd. Very hard to be in Asia and not talk about China. I know you've been on the China Business Committee internally for quite some time. Can you tell us a little bit about how it might be different, or what your views on China are as it tries to open up its markets?
Sure. China is a very complex country in that it's like an elephant. Depending on which part you touch, you can tell a different story. And for us, we take a much longer term view on China. We see it as an opportunity, even though we have to acknowledge that the risks are there in terms of things like the credit bubble that's built up, some of this pressure on exchange rate, and developments on capital markets, and so on and so forth. But I think, again, I'm coming from a fixed income lens, and I'm looking at fixed income opportunity. So, for example, even without having to predict, whether or not we're going to have a crisis, or we're going to have a hard landing and so on, which we don't think that's going to happen because conditions are quite different compared to many other countries. If you look at, again, longer term, 10 years, 20 years kind of time frame, some things are going to happen. A development of the capital markets is one thing that they're focusing on, and in the last few years, it has accelerated. So an asset class like China government bond market, you know that is already the third largest in the world, but in terms of foreign ownership, there's next to nothing today because the whole capital market is closed. But that's no longer the case today. So I think we're still at the infancy where investors are trying to get comfort around investing in China, especially in onshore market. But to us, it's a huge opportunity because where else can you get, we think, is a quality asset in terms of looking at reserves, in terms of the status of the currency at some point in the future, as well as the fact that it is still a very high yielding asset compared to many, many other bond markets in the world. So we think that at some point, these are going to be mainstream. This is going to be in index. This is going to be in many people's portfolio. It's a question of how you want to navigate from here till then.
Mm-hmm. Thank you. So Tina, earlier we discussed your appointment to the UN Empowerment of Women Committee. I'm not sure exactly if that's what it is, but
economic empowerment.
Yes. Economic empowerment, thank you. So can you tell us a bit about that more, and also tell us what corporates can do for that and the UN sustainability goals?
Yes, as if the day job scanning the globe for political risks wasn't enough, the head of research at Citi said, we'd like you to start writing about gender. And other than being female, I lacked qualifications in this department, and ended up collaborating with a friend of mine, in fact, who was Hillary Clinton's the first chief economist at the White House, rather, we wish, at the State Department, who had written about growth and worked with Shinzo Abe and others about women as global growth generators. That led to the appointment on the panel, but the course of taking on this new work stream in my research and the opportunity to go around the world talking to female investor clients and to companies, and companies are way ahead of the curve on this, I would say, especially in the fast-moving consumer goods space, has been an incredible process. Because I realized how little awareness we have, and I would extend this particularly to my fellow Americans, about the barriers to entry for women in the labor force in some cases, and also just the obstacles to progressing. And why do I single out the United States? Well, we're almost the worst in the OECD countries in terms of the number of barriers for women, the lack of maternity leave, let alone parental leave, subsidized childcare, and other kinds of support that help women participate at higher levels. How do we expect to be able to deal with the coming impact of the automation of the labor force when we haven't even taken on board, institutionalized the kinds of social protections that are not just good for women, by the way, but good for parents, families, and let's not even start talking about what's going to happen with our pension outlook when we're not developing policies that allow greater levels of female participation in the labor force. So the UN panel is not about diversity, it's about women's economic empowerment globally. So that means everything from changing laws. Over 100 countries still have on the books laws that don't allow women to inherit title, to own real estate. Financial inclusion is another part of it. I co-chaired the working group on changing business culture and practice along with Justine Greening, who's the Minister for Equalities in the UK and the Secretary of State for Education. And the report that we produced, which is online along with everything else that the panel did, looked at how companies can take a value chain approach. So yes, working on diversity and policies internally, but also promoting procurement from female-owned enterprises, right? All companies buy staples and toilet paper and whatever it might be, but you can do more to buy these from female-owned enterprises. That gives them more access to capital, that allows them to expand, and also aligning what you do in the community development space to look at those activities through a gender lens. And what we're really looking at is empowering women and girls around the world, not just because that is the right thing to do or a good thing to do, it's also the smart thing to do from a social and economic perspective, because what has been documented time and time again is that when women have more money in their pockets, they spend it on children's education, they spend it on healthcare, and they spend it on things that deliver benefits for all of society. So when we get together in these fora, and it's wonderful to see such a fantastic group of committed women, I want to leave one idea with all of you, which is, yes, we have more work to do for ourselves, for female CEOs, for board representation, but let's also think about how in our investments and in our work, we can do things for that girl who is spending 4 hours carrying water because there's no infrastructure in her country, and ways that we can make that part of what we do as well.
Thank you. So, Tracey, you've made a switch recently, so let's move to career-wise. You made a switch recently from Citibank, investment banking, corporate banking to wealth management. Tell us a little bit about that. And would you have told yourself to do that when you wrote to yourself back in 1980?
So I've always had a career in investment banking, and that's what I've done for the last 35 years. when UBS first approached me, the idea of actually not just always helping entrepreneurs and business owners with respect to their public assets, and as you all know, they probably, well, the majority of them probably have more than 90% of their assets that are not public. And I thought to myself, now that would really be interesting to be able to carry the dialogues that I've had with them, not just for 10% of their businesses, but actually to go a lot further back and think about how I could be helpful. So that was really the start of it all. And you will find this in my letter. One of the things I said to myself when I made the switch was that many people were actually expecting me to announce my retirement, and instead I made a career change. And this is really an advice I think I would give to everyone, that you should never stop learning to learn. And to me, the switch was just something so irresistible to be able to learn. What I've come to realize, though, having made that switch, is actually a couple of things. One, in the wealth management world, there's actually far more women than there are in investment banking. I think when I was in investment banking, I don't think I had more than 2 women in my department at any one point in time, sadly. Whereas in wealth management, there are clearly a lot more women. And so I do spend a lot of time with the women in the industry and thinking about it. Clients are also actually very different in wealth. Whatever that's not public, that belongs to them, they look at it very differently, and they think about transition of wealth very differently. One thing that has actually inspired me a lot in UBS, and this is something I co-chair and I lead, is actually about women in wealth. Some interesting facts for you. The amount of wealth transition that's going to happen to women around the world is huge. And actually in Asia, 50% of female billionaires are actually self-made. So you can think about how much actually the women folk are going to come into wealth and actually be able to drive change in the world as well. And women, I do believe, look at world slightly differently. It's never just about return for return's sake. I think it's nice to know that women think about investments from a societal, from an impact investing perspective as well, and not just solely for returns. So it has been a wonderful journey.
Thank you. So Elena, maybe to rival on the risk side from Tina earlier, is there anything you want to say about APAC risk, because you focus here so much? Opportunities, risks, what do you see on the horizon?
Okay, thank you, Mike. I'll try to rival Tina in being the most optimistic person on the panel. Let me talk a little bit about risk as we see them from the macro credit perspective. There are 4 main risks in the near to medium term. The first one is rising interest rates and foreign exchange costs. This is in the environment of Asia-Pacific corporate borrowers, particularly corporate borrowers, but also some governments, some households, increasing their leverage. And corporates have been borrowing a lot in foreign currencies. So as interest rates are expected to rise, and as we might expect some volatility in capital flows, the risk of interest rates rising and foreign currency costs will be definitely there, especially for highly leveraged borrowers. You might be interested to know that there is about $1 trillion worth of debt, rated debt, coming for refinancing over the next 5 years. So that's quite a heap of debt, and therefore the risk associated with it is significant. That's just in Asia Pacific, and that's probably 1/10 of all global debt coming for refinancing. The second risk is linked to it, and that's a market reaction to political events. Tina mentioned a few, some coming from developed markets, some from developing, driven by the population or driven by unpredictable leaders like Kim Jong-un. But we've seen this volatility in the markets. Capital can flow in large amounts. It can also flow out quite rapidly, and therefore put pressure on currencies and borrowers. The third important risk is the disorderly adjustment or potential disorderly adjustment of the property market. You know, it's interesting, we are in the 20th anniversary since the Asia financial crisis, and countries have been working really hard to adjust some of the main causes of the financial crisis itself. So more flexible exchange rates, better risk management in banks, better capitalization of banks, etc., etc. Yet one fact is really important, is that asset prices, and particularly property prices, today are as stretched as they were before the Asia crisis. So this is food for thought. And if you combine it with increased leverage in the household sector, lower affordability of real estate, and look particularly at Sydney, Hong Kong, Shanghai as areas where property prices are stretched, it is a risk that is worth monitoring. And the last one I want to mention is China debt overhang. I think Tsumi mentioned a little bit about China, that the risk is not yet imminent, the crisis is not imminent, yet it's one of the significantly leveraged countries these days. The total debt burden is somewhere roughly around 260 to 170% of GDP, and the bulk of it is corporate borrowing. Almost 160% is corporate borrowing. So that's another risk to watch. Asia has become much more dependent on China than it was 20 years ago. And these days, a crisis in China, if it happens, would potentially have significant repercussions for the rest of Asia-Pac. So that's on the risk side. On the opportunities, let me mention one thing. We do global Capex surveys every year. And we survey 2,000 companies globally in terms of how much they plan to invest in capital expenditures. And this year, for the first time in 5 years, the survey came back with positive results, saying that actually global Capex is going to increase by 5.5%. It's a small number, but it's a very significant number, because this indicator is very important for sustainable economic growth and for the health of companies. It could have been within a margin of error, but it's supported by other flags that came earlier. R&D spend, improving operating performance of companies, the reduction of the commodities investment crunch. So it's significant data. It kind of talks about companies becoming more optimistic about the future of the world, starting to invest and creating this positive virtuous cycle of investment growth. So that's, I think that's one positive. I cannot leave it without a little but on the side. Some of the investment is going into competing industries. So watch out for industries like auto and at the same time technology and retail, which potentially may end up badly. So that's, I couldn't have ended on a positive note, could I?
You almost did. You almost did. You were that close.
Almost.
Can we take, we have a little bit of time left. Can we take one or two questions? I suppose they come up here. Is that how it works? Okay, data as a disruptor is a theme. Too much data can create misinformation and conflict. What can we do to increase trust to disrupt effectively and manage uncertainty? And I throw that out to anybody here who would like to tackle that. Anyone?
I can try. So this whole thing about technology and big data has been a big theme in the company, in GIC, and it's been such a key focus across the entire firm that we even hired a CTO, a Chief Technology Officer, who is a woman, by the way. So the idea of using data is a very powerful one, because right now with machine, you have ability to use massive amounts of data, and not just structured data, but unstructured. But the key, like what this question is alluding to, is that your data must be clean, your data must be reliable. So hence, I think the need for organizations to think about creating a new profession, essentially, right? A new job, a new skill set, about ability to manage data effectively, so that you don't rely too much on false information. In fact, the whole this buzz about big data is that even though it's so promising, reality is a very difficult job to be able to get useful data that you can really have alternative signals on. So I think there are different ways to deal with it, but I think a very fundamental question about the business setting is that you need to think about your business structure quite differently. So for example, in our case, an investment, in the past, technology or data has always been treated as a separate sort of department altogether, providing technological solution as and when you have problems. And then investments is all, a separate group altogether. But I think in future, you do need somewhat of a hybrid model in that the business people need to appreciate and understand what technology can do. At the same time, the technology people would need to understand the business so that you can co-think about solutions together. So I think part of that answer to the question is just creating this new business structure and trying to create a new skill set and move to a model where you really can have a hybrid model of the best of both worlds.
Maybe I can just add one sentence. I agree with what Tsumi said. I would say we probably need to move towards more data aggregators and sources which can combine different types of data, different sources of data, and cross-check them against each other, right? So that the final outcome, the insight or the analysis that comes out actually takes in all the data, but cross-checks it against each other.
Wonderful. Well, I want to thank everyone who participated in the panel. The red lights are flashing. I think we'll be ejected shortly. So thank you very much for your time, and I appreciate it. And thank you for our panelists.
Thank you.